When you look at a stock market screen, you see a price. Maybe it is $100, $200, or even $1,000. But that number does not tell you exactly how much the company is really worth. Behind every price is something much more complicated. Millions of investors trying to predict the future. A company can have successful factories, thousands of employees, growing sales, and innovative products. Everything in the real business may look perfectly healthy, yet its stock price can move in a completely different direction. This is where one of the biggest misunderstandings about the stock market begins.
The stock market does not simply price what a company is today. It tries to price what investors believe that company could become tomorrow. That means the price you see on your screen is not just a reflection of the present. It is a constantly changing prediction about the future. And this creates a fascinating paradox. A company can be excellent and still be bad investment. Imagine a business with strong products, growing profits, and an impressive future. If investors have already pushed its stock price extremely high because they expect all of that success, there may be very little room left for the stock to rise. This is why a great company does not automatically mean a great stock. The important question is not only how successful the company will be. The real question is how much of that success is already included in the price. In the stock market, expectations can sometimes matter more than reality. Now comes one of the strangest things about investing. A company can announce record profits, beat its previous results, and still watch its stock price fall. At first, this seems completely irrational. How can a company perform better than ever while investors sell its shares? The answer is expectations. Imagine investors expected a company to earn $100 million, but it earns $110 million. That sounds like great news. But what if investors were actually expecting $130 million? Suddenly, the same result becomes disappointing. The company did well, but it did not do as well as the market hoped. This is how the stock market looks into the future. When you buy a share, you are not only buying the company as it exists today, you are buying an expectation of what that company may earn in the years ahead. And those expectations depend on economic growth, technology, competition, consumer demand, interest rates, and countless other factors. Interest rates are especially important. When rates rise, future profits can become less valuable in today's money. Suddenly, investors may be willing to pay less for the same future earnings. The company may not have changed at all, but the price investors are willing to pay for it can change dramatically. And then there are unexpected events. A single piece of economic or corporate news can change the way millions of investors see the future. The factory does not suddenly disappear. The employees are still working, production continues, but expectations can change within seconds, and the stock price can move long before the real business changes. This is where human psychology enters the story. Two investors can see exactly the same information and reach completely different conclusions. One sees an opportunity, another sees danger. When millions of these different opinions collide, they produce one market price. Sometimes rising prices create even more optimism. More people begin to believe that the stock will continue rising, so they buy. Their buying pushes the price even higher, which creates even more confidence. Expectations can begin feeding themselves. And when expectations move too far away from reality, the market can become dangerously fragile. This is why price and value are not the same thing. A real company has factories, employees, products, customers, technology, and cash flows. These things exist in the real economy. But the stock price is constantly influenced by what investors think those things will be worth in the future. The price is visible. Value is much harder to see. Price can change in seconds, while a company's underlying business may take years to develop. This is why watching a stock move is easy.
But understanding what that movement actually means is much harder. The market shows you a number, but the number does not tell you the whole story. So perhaps the most important question in the stock market is not what is the price. It is what expectations are already built into that price. The price can change, the news can change, expectations can change. But behind all of them is still a real company operating in the real economy. That is the real stock market deception. The price you see is not reality itself. It is the result of millions of people trying to predict the future at the same moment. So I am not saying ignore the price. I am saying understand what the price is trying to tell you. Because in the stock market, you are not buying the past. You are buying an expectation of the future.
Until the next video, I wish you good investments. But remember, what you're buying is the future. Goodbye.